Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would usually be the governor, the mayor, Mr. Michael Becker, the smartest guy in the room. But he is out on another due diligence assignment. So we wish Michael and his group at SPI a tremendous amount of success. So they just keep knocking the ball out of the park. So congratulations to Michael and his group. Joining me in the podcast today is the professor, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
Thanks for being in the podcast, James. We appreciate that. Today in the podcast, we have two guys that we've known for a number of years that we think are very talented in the space of selling multifamily properties in the Texas area, specifically in the Dallas-Fort Worth area, and also the secondary markets of Texas. So in the podcast, we're going to have just a general overview conversation with two very successful guys. Taylor Snowdy. Taylor, how are you?
Good. How are you?
And then James Roberts, also with Northmarq. James, how are you?
Doing good, thanks.
So I thought we would just kind of talk a little bit about how things are going. And James, I'm going to turn it over to you.
All right. Thanks for coming in, guys. So maybe just, I know we've maybe talked and some people saw you at our conference, but maybe just give people a brief overview of sort of your background and sort of how you got to where you are now.
Sure. So I've been doing this almost 15 years now. It's Taylor here. And we just recently joined Northmarq. We were at Transwestern for 13 years. So our team exclusively really focuses on the kind of middle market space, the Class B multifamily 100 unit to anything as high as we're working on a 600 plus unit transaction right now and sold to 800 units. So anything that our clients have is what we focus on. We'll do about $1 billion in deals this year. We work on the secondary markets in North Texas, East Texas, Panhandle quite a bit. There's 4 brokers on our team, one that's kind of a hybrid, and 3 support people on the team. So we've got a pretty large team here.
Mm-hmm. And I'm James Roberts. I've been on the team since 2011. I started as their financial analyst, transitioned into brokerage in 2013. Up until about a couple of years ago, I was primarily doing secondary and tertiary markets throughout Texas. While that's still a focus of our team and myself, I've kind of transitioned a little bit more into DFW. So just out there brokering, mostly workforce housing here in DFW, North Texas.
So what do you think? We've interviewed a lot of listing brokers. We had 3 or 4 at the conference. What do you think separates you guys from some of the other ones in the market?
I'd say we're very hardworking. I mean, we're all young guys in our 30s, and we grind very hard every day. So our reputation in the market is paramount for us. Us performing for our clients and getting the highest pricing possible and getting repeat business is very important. So we're one of the most active in the B and C market in Dallas, and we want to keep it that way. So we're always hustling.
Let's talk a little bit about that in terms of amount of volume. 2017, how much multifamily business did you guys close?
So 2017 was a record year for us. We did about a little over $600 million in volume. So we'll do $1 billion this year. So we're up over 50% this year, which will translate into, we probably were 9,000 or 10,000 units in 2017. And so we'll be 13,000 or 14,000 units this year. So transaction volume up big time for us.
So either one of the top 2 or 3 or the top listing group in the Dallas-Fort Worth area just by volume itself, because you sell units of 50 to 500 doors.
Mm-hmm.
You don't do the smaller projects, correct?
Yeah, I would say our average deal size is north of 200 units, probably 250, and $20 million price tag. But we definitely, we just sold a 75 unit deal in Lubbock, so it really just depends on the situation, the client, and what have you.
So what are you seeing sort of right now impacting either buyers, sellers? What's sort of if you had a sort of top 3 things that are impacting the multifamily space right now, what would they be?
I would definitely say interest rates at this time right now, just because we've seen the 10-year Treasury move quite a bit in the last month, and that's kind of the hot topic right now for everybody, where debt proceeds are, how does that line up with cap rates, and just basically getting buyers and sellers in line, because that's our job.
So when you talk to, what's the conversation? Let's say we have a $20 million deal, 10-year treasury runs up 30 basis points, 40 basis points with us. Then, what's the conversation with the seller? What's the conversation with the buyer?
Well,
So
let's put it in perspective.
Yeah.
When was the conversation? Was it 3 or 4 weeks ago, or is it today?
Let's just say today. So you're in the deal, and the buyer's saying, well, now my loan proceeds are lower. Can you help me out on price? How's that conversation going between seller and buyer right now?
So the stuff that we BOV'd was BOV'd prior to this run-up. So what most people are...
And what's a BOV?
A BOV is a broker opinion of value. It's basically where we value the property and give our kind of estimation on what we're going to sell it for. So that's typically done a month before we put it on the market for 30 to 45 days, and then we kind of determine pricing. So offers are coming due on a lot of that stuff right now, where the treasury run has happened post BOV.
Okay.
And so what we're seeing is the positive is that this market run has been great, and our sellers have plenty of profits in order to negotiate with, let's say. And I would say that the buyers are definitely pushing back and going, if my LTVs are going down and my rates going up, I can't pay the same price. So It's just more about educating buyers to stick with us, because we may have whispered something in the market, our whispering price, that may have been a little bit more aggressive than we had hoped, just based on our BOV. And we didn't want to necessarily let up on that pricing prior to really feeling out the market. And so stick with us, because it may sell for $5 a unit cheaper than we anticipated. And so that's fine, because we still have sellers that want to transact.
Okay. So sellers coming to the market, they're really trying to capture some of the gain that they've already, either through rehab, raising rents, maybe a little compression of cap rate. So giving back a little bit at this point in the game, they're okay with that, you're seeing, even though depending on where you are in the contract side of the deal, might be a little bit harder to convince sellers of. So interest rates being the big thing. What about anything else sort of impacting the market right now?
I would say supply. James, you want to talk about that a little bit?
Yeah, we've just seen, obviously a huge amount of supply in the A space, but, that really doesn't affect our segment as much in the workforce housing. If anything, I would say it's allowed owners to push rents to kind of bridge that gap between the A and B space. So we don't really see that as much, dealing with owners of B and C product. It's more of kind of a macro question we get. But, historically, Dallas has been able to absorb it, and we anticipate that to be the same moving into the future.
Yeah, there's probably 6 weeks to 2 months of concessions in the A space, and we don't have any concessions in
the B stuff.
market.
Okay.
Yeah.
And then have you seen any of your buyers, or, say you sell someone's deal this year, where are they taking the capital? Are they coming back and reinvesting in Dallas-Fort Worth, or are they going to maybe a secondary or tertiary market? Like where, because you probably have this conversation a lot more than I have it, is, great, Taylor, you can sell it for $20 million, but what am I going to do with the money?
Yeah. That's everybody's topic. I would say that they're staying in Dallas, they're redeploying the capital, and they're upgrading their portfolio quality typically. They want to buy a bigger deal, so the cash flow is stronger, and they're just using that money. I'd also say that they're just getting into higher quality Bs or moving into As.
And so when you do that, are their investors accepting lower returns to move up into that space, whereas maybe they doubled their money on this last deal in 2 years? Now when they move up in this market and go into higher quality stuff, whether it's moving from 200 to 300 and improving the submarket, are they accepting just lower returns on deals?
Absolutely.
Okay.
Yeah, and their 20 plus IRRs are basically unavailable anymore. Most guys are okay with the 15 to 17 IRR, and they're being stringent on their underwriting, and they're basically accepting that. What are the other options is what people are looking at. If you look at the stock market and the returns this year and what it's done in the last 2 weeks, it's still a great return in comparison.
So relative return.
And we will see sometimes, guys, if they get frustrated in DFW and can't win a deal and they're on a 1031 constraint, sometimes they'll venture out into the smaller markets, whereas maybe historically they wouldn't have looked there. So, it's not as common to somebody that already owns in DFW, but you do see it occasionally.
So the secondary markets, what maybe secondary, tertiary markets have you guys completed transactions on this year? And sort of give us an idea on that.
Again, secondary markets, Dallas, San Antonio, Austin, Houston are primary markets. Secondary markets would be Waco, Wichita Falls. Some of these areas that are whether they're 60 miles out or 90 miles out, they're just smaller marketplaces. They're good areas,
Yeah.
but just lower and smaller population.
Yeah. So, I mean, they have their own economies, but we've sold quite a bit this year in these secondary markets. We sold a $75 million portfolio in Lubbock. We sold a under $2 million deal in Lubbock. Just sold a 240 unit deal in Longview. We've done some business out in other East Texas markets. Kilgore, we've been working on some stuff. Get up into the Panhandle, into Amarillo. So it really just depends on the client, the situation. But usually it's a little bit less competitive out there for buyers, which they like. But that being said, you still have typical terms you'll have here in DFW. So hard money day one and standard timing, but it's just a little bit easier to win a deal. And your yield you're getting out there typically is 50 to 75 basis points higher on your cap rate. Usually that's what we're seeing. It's a little bit better yield and it's a little bit less competitive.
Some of the concerns someone might have going out there is in terms of sort of liquidity, and if the markets tighten up, will I be able to sell this deal?
Yeah.
So what type of debt structures, or maybe how are people protecting themselves in that type of market where if they go into a smaller market where there might not be any new construction?
Yeah.
Right. So they don't have to worry about that like Dallas, but then how do they handle just sort of maybe a longer term hold
Sure.
out in that market?
Yeah, I mean, that concept, we have not seen that translate into our sales, honestly. I mean, when we get a listing, it's usually pretty highly sought after. Like this deal we had out in Longview, we had 10 plus offers and it was pretty competitive at the top of the pack, hard money day one. So at least in this environment, we're not really seeing a softening of the buyer pool, but we do hear that a lot. And most of the time to combat that, what people will do is, put long-term agency debt on the deal, and it gives them the flexibility to hold the asset 10 or 12 years if they need to, or prepay the loan and sell it. That being said, we're seeing more and more people on kind of value add deals look at bridge options as well. So, they'll have a 2, 3, 4 year outlook on the project, and then they can sell it or refinance it into a permanent loan.
So you guys have probably, 8, 10 deals on the market right now. What are you seeing or feeling on those deals compared to maybe, let's say at the beginning of 2018, in terms of tour volume, in terms of number of bids expected, sort of how are you feeling about the market right now?
I'd say it's very deal specific.
Okay.
So we're marketing 2 properties in East Fort Worth right now. And yesterday between the 2, we had 15 tours. We've been absolutely covered up on the 2. So very deal specific. One's a 140 unit community, one's a 200 unit community, owned by the same group side by side. So we have some groups looking at it as a portfolio, and then the small guys looking at it individually, and our seller doesn't really care. We also marketed a 600 plus unit deal that bids were due more recently. It's just fewer guys want to take down a bigger deal or have the capacity to do that. So that one, we still had plenty of tours, but the offer level is going to be less than these smaller assets in Fort Worth.
Yeah, I would say definitely on the sub 20 million stuff that we're selling, there's just more guys that can do those deals. More groups out there that have the capability to syndicate a $20 million deal. So like Taylor was saying, the tour activity still is very high on those. But when you get into the $25 million plus price range, while we still have great interest, it's just maybe not as robust as it was a couple years ago.
Who is your typical borrower? Is it a small syndication? Is it an institutional guy? Is it some guy out of New York that's looking to buy a piece in Texas? Tell me, it's hard to put a generalization out there, but who's it going to be now and who was it, say, last year?
I would say one of the trends you're seeing in DFW is definitely the local syndication model and national syndication model for that matter. A good portion of our deals, sell to members of these syndication groups. We also have local and regional, I guess you would call them, real estate investment companies that already have a presence in Texas. But we still have your East and West Coast buyers come into town. Each offering we have has a different buyer pool, but it's still pretty diverse. But I would say one of the things we've definitely noticed, more syndication buyers in the market for sure.
So how do those syndication buyers, if they're offering on a $20 million deal, how do they prove to you that they're the ones, right? Because there might be 5 of them and they all might be within 100 to 200,000 a piece apart between them. But they're all, saying that they're going to syndicate the $5 million or $6 million in equity?
Track record, I would say, showing us you've been able to do it before, showing us you'll put up a sizable amount of non-refundable earnest money day one. That's something that basically speaks volume that I'm comfortable and I can close. We have a very high comfort level when you put up a lot of non-refundable money that you're not going to walk the deal. But also kind of coming to the table with your whole business plan, showing us your debt, equity, that you've had a contractor out there. There's not going to be any surprises. That's all weighs in.
Let's talk a little bit about that, because let's say that you turn a buyer trying to buy one of your properties. You put an LOI in. Your LOI is granted you with maybe 4 or 5 other people to have a conversation with the seller. So now the seller's on the call with you, and this is what happens in multifamily real estate, is that the seller and the listing agent who represents the seller kind of wants to find out a little bit more about you. What's your game plan? What are some of the things that you guys that represent the seller, what are some of the things that you guys want to hear? I know we covered just a little bit, but tell us, go a little bit more in depth. Think of terms of your sheet that you have the buyer complete. What are some of the things? And then reverse it. What are the things that you don't want to hear?
Yeah. I would say just one of the overarching themes is just projecting confidence and, being honest the entire time throughout the marketing process. I mean, that's usually the best indicator, are the groups that are calling us frequently, asking questions, coming out to tour, having their third parties come out and tour, having their equity out. You can tell they're spending a lot of time and it's a priority for them. That's huge. In terms of qualifying buyers, we want to know who you're talking to on the loan, what the sizing of the loan is, what's your rate, as much as we can find out and tell the seller to give them a comfort level, who your equity partner is, when can they come out and tour, what's the structure like, all of that.
On our best and final questionnaires that we have them fill out, the first thing the seller looks at is their CapEx number. How much do they think they're going to need to spend on this property? If it's extremely light and thin, the deal feels thin, that concerns them. If it's pretty robust and they feel like these guys have an understanding they're going to spend a lot of money, anything that may come up and surprise them isn't going to come back and affect the seller.
Tell me about maybe 2 things of all your years of doing this that the seller says, okay, we're going with that guy. You go into the transaction. A week later, the deal blows up. Why did it blow up?
It's usually, oftentimes you'll see that happen when someone comes in late to the game and doesn't have their arms around the deal from the very beginning and doesn't have all the facts and haven't done all their due diligence. That's really the only time you'll see that. But in this environment, with it being as competitive as it is in DFW, most of the time that's pretty well vetted on the front end. And by the time that we have an agreed upon LOI, there's substantial hard money at risk. So hopefully they've done their homework.
Now we have 7 or 8 million people in the Dallas-Fort Worth Metroplex, and Austin has a huge number. San Antonio, that we do a ton of business in the San Antonio market. How small is this marketplace if you start to get a bad reputation? What happens when you do not carry out or are not able to execute correctly? Whether it's on the lending side, on our side, or it's the borrower side, what happens?
I would tell you, if somebody drops a deal or loses earnest money, I probably find out within 48 hours that happened if it's not my deal. It's a very small market. There's only, let's say a handful of guys that we compete with in this market. We all talk to each other. We all call each other and say, there's so much publicly available information now that all you do is you look on CoStar or whatnot and who brokered it, and you call them and say, how were they to work with? Were they easy? Did they delay things? Did they retrade the seller? So a very small community, very paramount that you perform with us specifically. If you don't perform on a deal with us and try to buy another one from us, it's going to be hard to do it. And we control a huge percentage of the market share here.
Yeah, reputation in this marketplace, whether it's the Dallas-Fort Worth or the Texas marketplace or in your marketplace, wherever you're at, this is a very small community in the multifamily side. As I've said before, we're 7-8 million people. And if you take a look from the east side of Dallas to the west side of Dallas, to the northern part of Texas to the southern part of Dallas County, maybe there's 50,000 residential realtors in that space. 50,000. In the multifamily space, there's probably 50. And in the B and C workforce housing space, there's probably 18 or so. And the 18 are fairly friendly, and it's a competitive environment, but they all talk. So make sure the overriding theme, I want to make sure that before you put a bid in, before you put an LOI in, make sure you talk to your equity, talk to your attorney, talk to your management company, talk to your lender. Make sure that it's just like launching a rocket. Go around the table, make sure everyone's thumbs up on this transaction before you put your reputation at risk. James, you're laughing. Why is that?
No, you're absolutely right. That's true. I think it's just, people, especially when they're starting out, they tend to get overwhelmed with maybe some of the things that they discover in a due diligence. But, long term, it's a lot better to absorb $50,000 of deferred maintenance you found on a tour rather than terminate a deal. If your end goal is to grow a portfolio, saying you don't retrade and you don't drop deals, that's how you grow in this market.
Yeah, the retrading is the toughest part because we have a lot of engineers that come into this business and they may have not bought a multifamily before, and they go through a tour in the property and they start beating up the property, thinking that's how it is in the single family side, that you kick the tires and you find that you may have a gutter issue, you may have a foundation issue, you may have windows issue, you may have electrical issues in the property, and then you start trying to beat up the listing agent, and the listing agent is like, next. I don't want to deal with the problems that you are trying to uncover or solve just on a tour. So, get your engineer out here, find out somebody else is familiar with the properties in this area, but don't try to beat it and try to lower the price just on the first property tour.
And another thing, we mentioned this on another podcast, but just your ability to respond to shocks. So whether that's interest rate shocks, physical condition shocks, obviously do as much due diligence as you can, prepare your equity, prepare your lender, prepare all those people to be in the right spot at the right time, and do everything that you can to move the deal along. But in this environment especially, you're going to have to be prepared for stuff that comes up. And so a couple more questions here that I wanted to hit on is, you guys talk to a lot of buyers and a lot of people. What would you say the overarching number one theme that you see across buyers of why they like this market here in DFW?
It's performed so well for so long, and the outlook is so strong. It's still affordable in terms of a national perspective. Housing values, interest rates going up only works against people buying homes. The job growth figures here have surpassed 100,000 consistently. It keeps going up, and the fundamentals are very strong. All this stuff that we talked earlier about interest rate movement, buyers and sellers, that's all capital market stuff. Fundamentally, there's still no concessions in the market. Occupancies are strong. Rent growth may be moderating a little bit, but it's still there and viable. And so people have made a lot of money in Dallas, and they keep doing it. And we're kind of in a housing crisis here where they're not building affordable housing. And the growth we're seeing is in that space. So long-term viable market.
And if you had one risk, what would it be?
I would say if you're looking at the job growth stuff moderating a little bit, people are underwriting a lot of rent growth for the future. And if that just completely goes away, or we see another tsunami like 2008 or 9, that would but people just don't see that coming because the fundamentals are so strong right now.
So in, let's say 8, 9, and 10, what happened, or what did you see in your chair sort of, you were in this market? What happened in 8, 9, and 10 to a lot of these multifamily owners? Was it rent growth declines, occupancy coming down? How did these guys survive in the sort of 3 or 4 years where it was a little bit rougher?
Yeah, the foreclosures we saw were pretty much bad owners, but the deals were undercapitalized. That when they had to come in and do improvements, or the city got on them for whatever, siding, or the roofs came up to be replaced, they were not capitalized properly to handle it. The ownership groups that experienced occupancies going down and a little bit of concessions, maybe bad debt going up a little bit, didn't lose properties for that. They just went through some lean years and made it out. The positive right now is we're seeing 5 years IO on a lot of stuff. So you can absorb a lot of market fluctuations when you have that on your side.
Yeah, a lot of deals, with IO, you might be at a 2.0 debt service coverage right now. So there's a little bit of flexibility. So the investors might not be hitting their 8, 9% cash on cash, but maybe it's a 2 or 1, and maybe you're holding some of that cash while you're going through a downturn. So is there anything else that's on you guys' mind right now that you want to relay to sort of our listeners?
One thing we talked about was how many assumptions we've done this year versus all cash. We've only worked on one assumption deal this year, and we've offered multiple deals both ways, and it just seems like everything's gone all cash. Now, the movement that we've recently seen in the rates is making a lot of these other deals a little bit more attractive, looking at supplemental loans. So I think that's a trend that we're going to see over the next quarter, more stuff being brought out on an assumption basis where some of these loans are attractive.
From the seller's perspective, do they care?
Just as long as they net more after prepay or post-prepay now.
Right.
I know that it's like asking what kid you like more in your family. Do you like your daughter? You like your son? I'm going to ask you that question. What market do you like here in the DFW secondary market? What markets do you like? What specific areas do you like?
I would say what we've really focused on is right now we've worked on a lot of stuff in the East Fort Worth, west of Arlington. If you look at Fort Worth in general, there's just not a lot of housing outside of downtown when you move east. So we've worked on stuff in like the Woodhaven submarket of late. When you look at that submarket, historically 5-10 years ago, it was one of the rougher pockets in all of Dallas-Fort Worth.
Which is absolutely amazing because these properties were built in late 70s, early 80s in just a beautiful, gorgeous single-family community, private golf course, everything nice. And then back in probably the 90s or so, all the developers started to sell their properties. Some of the investors from out of state bought some of these properties, and they just used them as ATM machines and never put any money back into the properties. And they went almost straight down. In fact, some of the people would jump out of the apartment buildings, walk down the golf course, put a gun into the golfer's back pocket looking for their wallet, and jump back up into the property. So there's been a couple of groups that have done a great job, Madeira being one of them. We'll single them out. They went out there and they bought, 12 buildings in that submarket. And it's amazing what one group that has a vision that goes in and finds a good marketplace, just like you find the crappiest house in the best neighborhood that you want to buy, they found the crappiest neighborhood, and then they really have done a wonderful job of fixing up the properties in that marketplace.
Yeah, so what we've seen is their goal was come in, buy most or at least half of the submarket and clean it up, which they have. They've reduced crime in the area by 90%. They've won awards from the City Council and Dallas Police Department. It's now the third safest workforce housing in all of Fort Worth.
Yep.
And so they didn't over improve thinking they were just going to come out and clean it up. So what's left is they haven't really done the interiors. Now we're seeing it's the number one rent growth submarket in all of Dallas-Fort Worth. It's on 9.5% in the last year. So we've got a couple listings in there right now. We've got more to come in the submarket, and that's going to be on fire.
Yeah, Madeira did 1.0, and now the next generation coming in to buy it is looking to do the 2.0 in the upgrades to the properties themselves. And I tell you, they have won a bunch of awards, and the single-family owners around the neighborhood love them. I mean, because they really have changed that big aircraft carrier of multifamily C-class properties. They've changed that aircraft carrier to a different direction. So my kudos to Madeira and their group over there.
Yeah, and I mean, at this conference we were at yesterday, they really talked about how, vacancy historically on C stuff has been, 8-9%, and A's have been 4 to 5, and now they're seeing sort of an inversion on that, and C stuff nationally and in DFW is closer to 4 or 5%, and A stuff is 5 to 6. And so it'll be interesting to see how long that stays, or if that's just a shift, and that's just because of the amount of supply or lack of supply, and people are just having to stay in these units longer.
James, what's getting higher rents these days? What type of amenity packages are you seeing?
Yeah, I mean, so at this stage in the cycle, you're seeing, a lot of second-gen value-add opportunities where the owner's already come in and done at least kind of the basic value-add. So your vinyl flooring, resurfaced countertops, lighting packages. What we're seeing now is kind of taking it to the next level. Backsplash in the kitchen, brush nickel fixtures. You're starting to see more and more owners, especially in these submarkets that are turning over, try hard surface countertops, stainless steel appliances, just an overall higher end renovation than maybe that submarket had seen 2 or 3 years ago. Also seeing the incorporation of smart technology into a lot of these units, which is kind of a new thing we're seeing on our listings. So you can still find what we like to call blank canvas value add, where you go in and do $5,000 to $10,000 a unit type renovation, but most of that stuff is already transacted to this point.
So any sort of parting words or advice for the aspiring investors or people with a couple properties under their belt as they sort of move forward in this market?
I would say, just reach out, make yourself known, reach out to the listing brokers in town, reach out to Paul and James here, and just get to know us. So when it is the right time for you to pull the trigger here in DFW, we'll know who you are. And we're always happy to answer any questions you have, talk through underwriting and that sort of stuff.
And we're happy to tour properties. Don't feel like calling us or asking us for a tour is too much, or you need to go through somebody else that knows us better. I mean, we're available, and our job is to get out there and tour and listen to every prospect and help coach you on the phone, and we're happy to do it.
And if somebody wanted to actually sell or list a property with you, do you guys do that too?
We do a little bit of that, definitely. Yeah, no, we are listing brokers first and foremost. So, if you own a property in the DFW area and you're just even curious about what the value is, we're happy to do, complimentary BOVs. That's what we're here for.
What do they usually send to you? What do you need for you and your analyst to sit down, spend 3, 4, 5 hours going through an opinion of value? What does the seller need to provide to you?
Yeah, ideally we would get a trailing 12-month P&L and a current rent roll. And then if you have maybe a CapEx schedule of work you've done over the last couple of years. If it's an assumption deal, then we would need the loan terms and all that stuff. But other than that, we can pretty much get started. And, within a week or so, we can kind of give you an idea of where we think market value is.
Any concluding words, Professor?
I would say, these guys are, I think our line at the conference was leading the league in closings. Taylor Snowdy.
Well, it was certainly true. We did appreciate you guys being at the Old Capitol Conference at AT&T Stadium. We had 700 investors were at the conference. James and Philip and Taylor, part of the Northmarq team, were all up on stage at one period of time. And so we do appreciate you guys participating with us and giving people some inside information about what's going on in the marketplace. Again, we failed to mention at the beginning Philip Wiegand, and Philip has been with the team for a long period of time. He is a great person to talk to about multifamily too. So he's part of the Northmarq team. So we don't want to forget about Philip at all. If people wanted to get more information about maybe talking a little bit about doing business with you guys, know a little bit more about the Dallas Fort Worth marketplace, what's the best way for them to reach out and touch you, so to speak?
Yeah, go to our website, www.northmarq.com, MARQ. My email is tsnoddy, SNODDY at northmarq.com.
Yeah, and jroberts at northmarq.com.
Fantastic. Taylor, thanks for coming in. James, thanks for coming in. We appreciate that. Professor Rang, thanks for the good words of wisdom.
Thank you.
Thanks for having us.
Yeah, thank you.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.